Hello, friends. My name is Brad Durson, and I am here to help you learn more about how the Federal Reserve implements monetary policy. The Federal Reserve, commonly referred to as the Fed, is the central bank of the United States. And the U.S. Congress, our friends in Washington, have given the Fed two objectives, which we call the dual mandate. One is to promote maximum employment, and the other is to promote price stability. What does the Fed do? It conducts something called monetary policy to move the economy towards this dual mandate. And what does the Fed use? It uses a lot of data to access whether the economy is at maximum employment or if the economy is high, low, or we're in deflation. So what do we look at for employment? The measures that we look to are the unemployment rate, actual unemployment numbers, and labor force participation numbers. And if the Fed sees that the economy is falling short or maybe above maximum employment, it adjusts its monetary policy to move the economy towards maximum employment. And there are many ways to measure inflation. And what is inflation? It's the change in the overall level of prices. And the Fed has stated that it seeks to achieve inflation that averages 2% over time, using a specific measure called a Personal Consumption Expenditures Index. So when the Fed thinks that inflation is too high or too low for an extended period of time, it will adjust monetary policy to steer the economy back toward the desired level of inflation. So let's look at who within the Fed makes these decisions. The Federal Open Market Committee, otherwise known as the FOMC, is the group within the Federal Reserve System that conducts or sets the stance of monetary policy. It does this primarily by setting the target range for the federal funds rate, also known as the FFR. And the Federal Open Market Committee is made up of 19 participants, the 12 Federal Reserve Bank presidents, plus the 7 governors from the Board of Governors of the Federal Reserve. And so let's take a look at that map. I'm living in Utah right now. Many of my students are living in Utah. So what Federal Reserve region are we in? We're in number 12. That's where Utah is. Of the 19 FOMC participants, 12 of the Federal Open Market Committee members vote on policy at any given meeting. This is a picture of a Federal Open Market Committee meeting held at the Board of Governors in Washington, D.C. All 19 Federal Open Market Committee participants attend the meetings.
And the President's report on the economic conditions in their respective regions. Utah is in Region 12 and Iowa is in Region 7.
But only 5 of the 12 presidents are designated as voting members in a given year. And they join the 7 governors to vote on policy decisions. As we move through this discussion, look for how the Fed and other central banks implement monetary policy. The flow diagram will be your guide. Now, pause the video here and read through the bullet points in the boxes on the slide for yourself. Did you pause? I hope so, because that's important information. So what do you think? If the interest rates were lower, how is that going to affect your decisions and producers' decisions? Think about it. Lower interest rates, money's cheaper to borrow, so we can go out and buy that car. Now, how would you react to higher interest rates? Do you think that producers would react the same way as you do? Let's take a look at some of the mechanics of the federal funds rate, which is the Fed's policy rate. First, banks hold cash in their checking accounts at the Fed, and the Fed calls these the reserve balance accounts. And if you're a bank that needs to borrow money, you can borrow money from banks that have excess funds. And so the transfer of funds from one bank's reserve account to another is termed a federal funds transaction. And there's an agreed interest rate in this transaction, and we call that the federal funds rate. The FOMC sets a target range for the federal funds rate, which is the Fed's policy rate. Did you catch that? Let's go over that once again, just kind of quickly. The Federal Open Market Committee conducts monetary policy, meaning they're setting the stance of the policy by setting a target range for the federal funds rate. And the federal funds rate is a key interest rate in the economy. So the mechanics are banks hold funds or cash in their checking accounts at the Fed. We call these reserve balance accounts. And banks that need funds to make payments or pay customers can borrow from the banks that have excess funds. And the transfer of funds from one bank's reserve account to another bank's reserve account is termed a federal funds transaction. And the agreed interest rate in this transaction is the federal funds rate. The federal funds market is an electronic payments market where banks that need funds, meaning they need more reserves, go to borrow funds from banks that have excess reserves or excess funds. And for each transaction, for example, today, funds are transferred from the lender's reserve balance account at the Fed to the borrower's reserve balance account at the Fed. It all takes place there at the Fed. At that time, there's an agreement to reverse the payment the next day, where the funds are returned with a little bit more than borrowed, reflecting the stated interest payment. And the interest rate that the borrower and lender agree upon is called the federal funds rate. And it's important to note that the federal funds rate is market determined by the borrowers and the lenders. The Fed does not set the federal funds rate. The Federal Open Market Committee sets a target range for the federal funds rate. It is the range where it wants the federal funds transactions to take place. When the Federal Open Market Committee moves the target range for the federal funds rate either higher or lower, the FMOC knows the federal funds rate and other interest rates in the economy will be affected and then influence the spending and investing decisions made by consumers and producers. For example, if the Federal Open Market Committee lowers the target range for the federal funds rate, this will lower interest rates in the economy. And what's going to happen? We as consumers and businesses are going to be encouraged to take out loans to spend and invest, therefore kickstarting the economy. Now, you know what the Federal Open Market Committee is now, so I'm going to shorten that and call it the FOMC. So when the FOMC meets, it sets a target range for the federal funds rate. The figure on the graph shows time on the x-axis and basis points on the y-axis. What are basis points? Basis points are related to percentage points. So basis points are used when percentage points are just really, really small. So 25 basis points is equal to 0.25%, not 25%, 1/4 of 1%, 0.25%. The figure shows the target range set by the FOMC over time in gray. And the FOMC has been setting the target range, the width of the gray range, to 25 basis points. In 2018, the target range was moved up multiple times as the FOMC evaluated the economy as gaining momentum and inflation moving up towards 2%. And in 2019, the target range was moved down a number of times when foreign economies were seen as underperforming. And the FOMC saw this as a real potential drag on the US economy. And in March 2020, when the COVID-19 pandemic hit the economy, the FOMC quickly moved the target range for the federal funds rate to close to 0.00 to 0.25%, nearly zero. And in 2022, what was happening? Inflation. So the FOMC raised the target range in response to that inflation that exceeded the Fed's 2% inflation target. Note that the Fed uses its monetary policy implementation tools to ensure that the federal funds rate stays within that target range. And this slide shows that its actions actually work. Remember, the federal funds rate is not set by the Fed, but determined in the federal funds market between banks. The red line is the market-determined median federal funds rate from all the transactions in the federal funds market. This rate, called the effective federal funds rate, is inside the target range. It's in the gray region set by the FOMC. So to summarize, the FOMC conducts monetary policy by setting the target range for the federal funds rate. Our next topic, how does the Fed ensure the federal funds rate is inside the target range? This slide is going to answer the question of how does the Fed ensure its target rate for the federal funds rate transmits to market interest rates between the banks. Here's the answer. The Fed implements the FOMC's policy decisions using its administered interest rates. This question used the word its administered interest rates in implementing the policy. So what does the word implement mean? Implement actually means to put a decision or policy into effect. Notice that the red implementation arrow explains that the Fed implements the policy decisions made by the FOMC with its monetary policy implementation tools. The Fed has tools to implement monetary policy in its toolbox. Two of the tools that you'll see in green text are linked to interest rates that the Fed sets or administers. These tools and their associated administered interest rates are used to steer the market, guided by policy rates in the FOMC's target range. So these tools also interact with other market interest rates to help set overall financial conditions. And the last tool, it's the blue text, is called open market operations. It's the purchase and sale of government securities, which is used to adjust the level of supply and reserves in the banking system. Beginning with slide 22, we're going to take a look at a different type of graph, and we're going to be using a little bit more international language and taking an international approach. So from this point forward, we're going to use the following terms. Central bank. All major countries have a central bank instead of ours, which is the Federal Reserve. So we're going to call the Fed the central bank. And policy rate instead of federal funds rate. All central banks have their own policy rates. They don't call them the federal funds rate. So because we're thinking internationally, we're going to say policy rate rather than federal funds rate. And interest on reserves instead of interest on reserve balances rate, because this is the language that most international banks are using. The graph that you're seeing is from the College Board. And this is the College Board's ample reserve graph showing the Fed's tools on a single graph. The Federal Reserve uses an ample reserves framework to implement the policy. This means that the supply curve intersects the demand curve at a point where small changes in the supply of reserves will not affect the policy rate on the flat part of the demand curve. Like any supply and demand graph, the price is determined by the equilibrium point, which is where supply and demand intersect. We know that very well by now. And on this graph, the price of the reserves, either to lend out or to borrow, is the policy rate that the Fed wants to target, indicated by PR1 circled in red on the graph. The policy rate on this model represents the federal funds rate in the United States. The discount rate is indicated by the unlabeled dashed line that forms the upper bound going all the way across. And we'll be talking about discount rates in the later slides. The supply curve intersects the demand curve in the horizontal or flat part of the demand curve. And the supply curve of money is always vertical because only the central bank
can manipulate the supply of money in the central reserve banking system.
And so the central bank adjusts the supply with its open market operations. So it's not supplied by all of the other banks. The supply of money is dictated by the central bank, and therefore it is vertical. If it wants to increase the amount of money, it will shift to the right on the curve. If it wants to decrease the amount of money, it will shift it to the left. And the bank does this by buying securities. It pays for those securities by adding funds or cash into the bank's reserve accounts. And that shifts the supply curve to the right. And when the central bank sells securities, it receives funds for them by subtracting funds from the bank's reserve accounts. which shifts supply curve of funds to the left. In order to understand how these tools work, you must first understand the demand for supply for reserves in the banking system. And the demand curve has three segments. The top portion of the demand curve is capped by the discount rate that the central bank sets. The middle of the demand curve is downward sloping because banks will demand a greater quantity of reserves the lower the interest rate. Makes sense, right? And banks want these funds on hand in case of emergency or a need for cash. And the bottom portion of the curve is nearly flat at some point because banks do not derive much benefit from holding the additional reserves. The remainder of our discussion will focus on how these tools used by central banks under an ample reserves model helps them reach their broad economic goals of stable prices and full employment. The first tool and the most effective and primary tool is interest on reserves. Remember, a central bank acts as a bank for banks. The central bank serves some of the same functions that commercial banks serve for people and businesses like you and me. If we need money or if we want to deposit money, we go to our bank. What do banks do when they need that same service? They go to the central bank. The central bank will take deposits and give loans. So when banks deposit funds in their reserve accounts at the central bank, they earn interest on reserves at a particular interest rate. Remember, the central bank can set the rate at whatever level it thinks is appropriate, and that is called the administered rate. So banks know they can put their excess funds in their accounts at the central bank and always earn interest on the reserve rate. Also, the central bank can be counted on to return their funds when the banks want to withdraw them. And this is what it looks like. No, actually, that's the Great Depression. When banks withdraw their money from the Fed, it's a very simple electronic transaction. So for banks, holding funds in their reserve accounts is a risk-free investment option. The interest rate on reserves rate is the interest rate that banks earn from the central bank on funds they deposit in their reserve accounts. The interest on reserve rates steers the policy rate into the central bank's target range. And the interest on reserves rate is shown on the graph as the dotted line extending from the bottom portion of the demand curve. The dotted bottom portion is the interest rate on reserve balances. The interest rate on reserves is an effective guide. Essentially, it helps steer the policy rate because of two key economic concepts: the reservation rate and arbitrage. I'll explain arbitrage later. Right now, let's take a look at the reservation rate. A reservation rate is the lowest rate that banks are willing to accept for lending out their funds. And the next slide shows how the interest rate on reserves acts like a reservation rate. We will be talking about the reservation rate and arbitrage. Now, both of those are not within the scope of your exam, but it is important to understand because they help explain why interest on reserves affect the policy rate. Banks seek to earn a return on their money. Banks say, oh, I know I can deposit funds at the central bank in my reserve account and earn interest on the reserves rate. Now, let me look in the market for other opportunities and see what I can get there. And this slide shows three options for banks that want to invest their excess funds overnight. They can also lend excess funds to other banks in the reserves market and earn the policy rate, which is the federal funds rate in the United States. They can also invest in treasury bills and earn the treasury bill rate. And all of these options provide banks with an overnight return on their money with very little risk. Now I think it's coming together. Because what if the policy rate and the treasury bill rate were around 2%, while the interest on reserves rate was 2.5%? If you were a bank willing to invest your money, what would you do? Would you take the 2% or the 2.5%? Things are becoming clearer. In this case, banks would deposit their funds at the central bank to earn the interest on the reserves rate because it returns the highest amount across similar investment options. And interest on reserves is a risk-free option for banks. And because banks seek the best return on their money, they will not lend or invest for less than they can earn by depositing at the central bank. So, the interest on reserves rate is a reservation rate for banks. This means that when given the option of earning 2% in the reserves market or 2.5% by depositing their funds at the central bank, banks would deposit funds in their reserve accounts at the central bank to earn the higher interest on reserves rates. That is the reservation rate. Some of these definitions are tricky. Econ may seem like a foreign language sometimes. That is why precise wording is important. Hang in there with another definition. The policy rate is a reserves market function because it directly influences the supply and demand for bank reserves, which in turn affects the broader interest rates in the economy. That explanation was the first concept about reservation rates. Let's move on to a second big concept called arbitrage. The second economic concept that makes interest on reserves an effective guide for policy rate is something called arbitrage. Here's an old-fashioned example. Way back before the internet, after the Berlin Wall had fallen, and after Russia had become a newly capitalized country, Russians could take their rubles and buy dollars in one city, hop on a plane, fly someplace else, and exchange those dollars for more rubles in another area. That's arbitrage, selling something simultaneously to be able to make a profit. So here's the definition. Arbitrage is the simultaneous purchase and sale of funds in order to profit from a difference in price. And the next few slides show how arbitrage ensures that the interest on reserves can be used to guide the policy rate and interest rates on other similar investment options. Recall from previous slides that the interest rate on reserves rate act as a reservation rate. This means that when given the option of earning 2% in the reserves market or 2.5% by depositing their funds at the central bank, banks would deposit funds in their reserve accounts at the central bank to earn the higher interest rate on reserves rate. So, will the policy rate stay at 2% if the interest rate on reserves rate is at 2.5%? Well, chances are that the interest rates will not stay the same. But why is that? Because when there is a difference between prices, the profit incentive of arbitrage will drive the two rates closer and limit or reduce the profit potential. Here's a definition. The policy rate would not stay far below the interest rate on reserves rate because arbitrage would close the gap between the two rates. So if banks would see a way to make a profit from the difference in the rates, they would borrow money in the reserves market at 2% and deposit that same money in the central bank and earn 2.5%. The profit in this example is 50 basis points, or 0.5% for every dollar invested. And this act is what we call arbitrage. Okay, everybody, hold on to your seats because we're going to go over some relationships using specific words. And words are very important in economics. Many banks are going to see this opportunity. They will borrow in the reserves market, that's a market, at the policy rate. So they'll borrow at 2% and deposit it at the central bank, that's a market, to earn the higher interest on the reserves rate. They borrowed the reserves at 2%. They're depositing them at 2.5%. This action by many banks will pull the policy rate up towards the interest rate on reserves rate by increasing the demand for those reserves. The increase in demand for reserves in the reserves market will allow lenders to start asking more for their funds, which puts upward pressure on the policy rate, and the policy rate will rise. This arbitrage will continue until the policy rate rises to the level that banks no longer see the opportunity to profit. Profits go to zero when the policy rate is at the same level as the interest on reserves rates. Now, that is a lot of information to unpack, but we're okay. The relationships explain everything because arbitrage ensures that the policy rate does not fall far below the interest on the reserves rate. Arbitrage is what makes interest on reserves an effective tool for guiding the policy rate. Arbitrage also works if the policy rate is above the interest on reserves rate. So how would arbitrage pull the policy rate down toward the interest on reserves rate? If the policy rate is above the interest on reserves rate, then banks will seek to increase the return on their money by withdrawing funds from their reserve accounts at the central bank and lending those funds out in the reserves market. And in this example, the return or the profit on this transaction is 50 basis points or 0.5%. Many banks will take similar actions. More available funds for loans in the reserves market pushes down the policy rate that borrowing banks must pay, moving the policy rate down toward the interest on reserves rate. So the next tool that helps the central bank accomplish its dual mandate goals is something called the discount rate. The discount rate is one of the administered rates set by the central bank to guide the policy rate. As we talked about before, the central bank serves as a bank for other banks, and banks that need extra funds can always borrow from the central bank at the discount window. When banks take loans from the central bank, they pay an interest rate called the discount rate. Because banks have access to funds from the central bank at the discount rate, they should not be willing to pay a higher interest rate to borrow the money somewhere else, including the reserves market, because this sets a maximum rate that banks should be willing to pay for funds. It sets a ceiling for the policy rate. Take a look at the slide and the ceiling rate. Graphically, because it sets a maximum rate and acts as a ceiling, the discount rate caps the demand curve. The discount rate is indicated as the upper dotted line on the slide. So in summary, we now know that with arbitrage at work, policymakers can confidently set the target range for the policy rate and be assured that trade will occur within that range. The central bank can increase or decrease the interest on reserves rate to steer the market-determined policy rate up or down as needed. When policymakers raise the target range for the policy rate, the central bank raises the interest on reserves rate, and that moves the policy rate up into the new target range. When policymakers lower the target range for the policy rate, the central bank lowers the interest on reserves rates, which moves the policy rate down into the new target range. The last monetary policy implementation tool is open market operations. Open market operations consist of the buying and selling of government securities. When the central bank buys securities, it pays for them by adding reserves to the bank's reserve accounts. Buy big. It makes the reserve accounts of the banks bigger. This is something like buying at a store with a debit card. Money is subtracted from your checking account and placed in the checking account of the store's bank. And when the central bank sells securities, sell small, the central bank sells securities to the banks. The banks now in possession of securities release some of their reserve funds to the Fed. And the Fed takes those monies, otherwise known as bank reserves, out of the nation's money supply, thus making the money supply smaller. Sell small. When the central bank adjusts the supply of reserves in the banking system, it uses open market operations. The central bank has stated it will operate within an ample level of reserves in the banking system. An ample level of reserves means that the supply curve remains far to the right in the graph, where the supply curve intersects the flat portion of the demand curve. On the flat portion of the demand curve, small shifts in the supply curve do not affect the equilibrium policy rate. The central bank uses open market operations to ensure that the level of reserves remains large enough to be ample. Why? There are some factors in the economy that will cause the supply of reserves to naturally shrink over time. So the central bank will conduct open market operations to purchase securities and add reserve. So why doesn't the central bank want the supply curve to shift too far to the left? If it shifted too far to the left, that would mean the money supply will intersect with the downward sloping portion of the demand curve, which interferes with the ability of the administered rates to steer the policy rate. And that's what the Fed wants to do. In this case, to ensure that reserves remain ample, the central bank will use open market purchases of securities to shift the supply back to the right. When the central bank wants to increase the level of reserves in the banking system, it buys government securities in the open market and pays for the securities by crediting or adding to the reserve account at the seller's bank. When the central bank buys securities, the level of reserves increases, shifting the supply curve to the right. So remember, buy big makes the money supply bigger, sell small makes the money supply smaller. Now we're going to talk about examples of expansionary and contractionary monetary policy. The last few slides will tie together the policymaker's action, moving the target range for the policy rate with their goal of full employment and price stability. So suppose the economy weakens and employment falls short of full employment. Meanwhile, the inflation rate, which might have recently been steady at around 2%, is showing signs of decreasing. Given the economic conditions, how does the central bank conduct monetary policy? And what's the goal of monetary policy? It is to achieve full employment and price stability. What will the central bank do? The central bank will lower the administered interest rates in order to steer the policy rate lower. Policymakers might decide to use expansionary monetary policy to provide stimulus for the economy. So what would policymakers do? Policymakers would decrease the central bank's administered interest rate in order to achieve a lower policy rate. Notice that the ends of the demand curve move lower, but that the supply curve is unchanged, as is the downward sloping portion of the demand curve. Only the ends of the demand curve shift, representing the change to administered rates. This slide illustrates that policy implementation comes after the policymakers decide to decrease the target for the policy rate. The graph on the left shows the central bank using its administered rates to lower the policy rate and the corresponding effect on the aggregate supply and aggregate demand graph in the right. Because the administered rates are reservation rates and because banks and other institutions arbitrage across investment options, the lowered administered rates push the policy rate and other market interest rates lower. These lower market interest rates make borrowing money more affordable. Lower interest rates decrease the savings rate and the cost of borrowing money, which encourages consumers to increase spending on goods and services, and for businesses to invest in new equipment. The increase in consumer spending and business investment, which is interest-sensitive consumption, increases the overall demand for goods and services in the economy, thus shifting aggregate demand to the right from AD1 to AD2. With increased production, businesses are likely to hire additional employees and spend more on other resources. Real output increases, which moves the economy toward the central bank's full employment goal. While not the objective of the policy, the model shows that an increase in aggregate demand will push the price level higher. In short, lower interest rates can be used to stimulate a weak economy, moving it toward the central bank's goal of full employment. Now assume the economy is growing at a very fast rate. Inflation has been above the central bank's target for a considerable time and is rising, and at the same time, the unemployment rate is very low. Given this economic condition, how does the central bank conduct monetary policy to achieve full employment and price stability? In this case, policymakers might decide to use contractionary monetary policy. Why? They want to bring inflation back to the central bank's target rate over time. And this means that policymakers will raise the target range for the policy rate. And this graph shows the upward shift in the central bank's administered rates when policymakers raise the target range for the policy rate. Notice that the ends of the demand curve move up, but the supply curve is unchanged, as is the downward sloping portion of the demand curve. Only the ends of the demand curve shift, representing the change to administered rates. And this slide shows that policy implementation comes after the policymakers decide to increase the target for the policy rate. This graph shows the central bank using its administered rates to increase the policy rate and the corresponding effect on the aggregate supply and aggregate demand graph. Because the administered rates are reservation rates, and because banks and other institutions arbitrage across investment options, the higher administered rates push the policy rate and the other market interest rates higher. That's the first bullet point. These higher market interest rates make borrowing money less affordable. Higher interest rates increase the cost of borrowing money and make saving more advantageous, and that discourages consumers from spending on some goods and services, and it also reduces business investment in new equipment. The decrease in consumption spending and business investment, which is called interest-sensitive consumption, decreases the overall demand for goods and services in the economy, thus shifting the aggregate demand to the left from AD1 to AD2. With decreased demand for goods and services, upward pressure on wages and prices dampens. As these changes transmit to the broader economy, real output decreases, inflationary pressures diminish, and the inflation will fall back towards the target rate. Here's a note about an unusual event called deflation. Contractionary monetary policy is shown on the aggregate supply aggregate demand model as a leftward shift of the aggregate demand curve, which results in a lower price level or deflation and lower output. That means a recession. In reality, deflation is rare. If well executed, contractionary monetary policy can achieve a lower unemployment rate and slower output growth without causing deflation and recession. This is often referred to as a soft landing. So higher interest rates can be used to restrain inflation and move the economy back to the central bank's target inflation rate. Now is an important time for you to stop the video. Stop it right here and review the key features of monetary policy with ample reserves. Make sure you do this review so that you understand everything that we've been talking about.
That's all, folks.